My name is David Schlossberg, and I am the founder and senior partner at Assured Concepts Group. Thank you for joining me today. We all would like to grow our invested assets, but to what end? There are many folks that invested in CMOs or collateralized mortgage obligations as the price was dramatically falling in 2008, hoping to buy at the bottom and win big. What many of those investors won instead was holdings worth a small fraction of their original investment. Some institutional investors that should have known better even saw the demise of their organizations as a result. At Assured Concepts, it would seem inappropriate to us for retirees and near retirees, or even younger folks for that matter, to think in terms of growing their money without also taking into account the risk to their money. Let me show you this chart to demonstrate the importance of risk evaluation. If we have three portfolios, one that has a 10% gain in year one and a 10% loss in year two, a second that has a 20% gain in year one and a 20% loss in year two, and a third that has a 50% gain in year one and a 50% loss in year two, it may appear as if they all wind up in the same place. After all, they all had a median return of 0. But indeed, they do not wind up in the same place. You see, if we invested $100 in the first portfolio and gained 10%, we would have $110. And then if we lost 10%, we would lose $11 and end up with $99. If we invested that same $100 in the second portfolio, we would gain 20% or $20 to finish year one with $120. But if we lost 20%, we'd lose $24 and have $96 remaining. And lastly, if we had $100 and gained 50%, we would have $150. And if we lost 50%, we would have $75 remaining. What if I moved the bar so that each 2-year period had a median result of plus 10%? So portfolio 1 was plus 20% and then 0% for a median return of plus 10%. And portfolio 2 was plus 30% and minus 10%, again for a median return of 10%. And portfolio 3 was plus 60% and minus 40%, again for that same median return. How do you think that would impact the results? Well, here's what we wind up with. As you can see, the 10% median return with less volatility had better end results than the 10% median return with higher volatility. And if I did the same thing, but now having a median return of 20%, here are those results. And again, the portfolio with lower volatility outperforms the higher volatility portfolio. In our office, we refer to this as the roller coaster. A simple question for you: which roller coaster would you prefer? You see, the more we deviate from the average, the more risk of loss we take on. The statistical term just described is called standard deviation. The more we deviate from the average, the higher the standard deviation risk metric will be. Standard deviation is just one of the many risk metrics we use at Assured Concepts in matching investment strategies to our clients' individual needs. Most individuals will need some growth of their investments to stay ahead of inflation and meet their vision casting goals and objectives. Others may not. Some will have a desire to try to grow their investments with the market, while again others will not. And then others will have a great desire to grow with the market until the market shrinks and their perspective changes. You see, everyone's investment needs are unique since we all have different goals and values and are in differing financial situations. So we should seek an advisor that understands our specific needs and can develop personalized strategies, as well as an advisor that can adapt to the client's risk tolerance changes as the market so dictates. At Assured Concepts, we don't just invest, but we also educate and inform. For example, for many investments, you can find statistical information such as standard deviation, beta, Sharpe ratio, and the like on various websites. But what many may not understand is that individual risk metrics are not what's important. It's the risk metric of the portfolio of investments as a whole that matters. You see, it's quite possible to take two investments with relatively high standard deviations, and depending on how those investments work together, possibly cut the risk metrics substantially without giving up much return in the process. Let me ask a few questions of you, starting with the concept of planning, or vision casting as we like to call it. Do you know with confidence the investment return that you'll need to achieve in order to meet all of your financial goals and objectives? And next, what amount or level of risk is required to achieve that needed return? And then lastly, is there a method of achieving that hopeful return, yet reducing the risk to a level that you may be more comfortable with, or just better serves your objectives? These are questions we look to answer when we provide our vision casting services at Assured Concepts. Please be sure to catch that video on our website if you haven't already. On the growing side, the question that I'd pose is, do you know the risk metrics for your individual investment holdings? You may, while we find that most do not. Of course, I've already implied that the risk metrics for the individual holdings is not what's important, but rather the risk metrics of the portfolio as a whole. So the real question that I should ask is, do you know the risk metrics of the sum of your investments? And if not, shouldn't you? Since you've worked a lifetime to accumulate what you have, you should know that. Based on our discussion, would you deem it important to know that information? At Assured Concepts Group, we have the tools to determine the risk metrics of your existing investments as a whole. Should you be interested in a complimentary analysis of your holdings, please feel free to contact us anytime. Thank you for joining me today. At Assured Concepts, we look forward to helping you meet your goals. I'm David Schlossberg.